Now, obviously, you would have heard this in multiple reports, multiple newspapers talking about this. India is expected to grow from a $3.5 trillion economy to a $7 trillion economy in 7 years, 10 years, 12 years. You can make your own assumptions. The point is not how many years. The point is, what does it mean? When someone says the GDP is going to double, it's really important to understand if GDP doubles, where is the wealth creation going to get generated? And this is the dichotomy in our country. What I have put down here is the various sectors and its weights in the index. Against that, the various sectors and the contribution to GDP. So while 41% of financial services on the banking side, which includes private sector banks and PSUs, contribute only 7.2% to our GDP, its weight in the index is 41%. Whereas manufacturing, auto, real estate, the weight in the index is negligible. All put together, almost 10-11%, low double digits at best. But the contribution to the GDP is almost 50+%. So one has to really take a pause and think about saying, if I'm going to construct an active portfolio, am I going to move towards financial services on the lending side because the PE is lower than mean? Or am I going to skew my portfolio where there is growth, which is going to be the driver of GDP, though the index weight is going to be low? So the question that one needs to ask as an active manager, am I going to stick to index weights? Or am I going to go after growth? For us, it's always been growth and not thinking about index weights because that doesn't contribute active allocation. So effectively, if you think about our own portfolio in this context, our largest weights are in B2B, manufacturing, auto ancillaries, real estate ancillaries. And here again, we don't like to own real estate developers because of the debt, because of the cyclicality, and because of the fact that it doesn't lead to incremental shareholder returns. Instead, we would own the ancillary businesses who are predominantly market leaders and much cleaner balance sheets and a much better capital allocator. So for us, owning the market leader in each one of these supply side economies is extremely important, and that's how our portfolio is positioned. So in order to summarize all of this, what are we saying? At ITIS, we will continue to invest in growth. Within growth, allocating to the right promoter and the right valuation becomes extremely important. When you think about the market still is fairly valued in my mind. There are areas of froth, specific pockets of froth building in, and hence paying attention to valuation is extremely important here. Rather than talking about market hitting new highs and is the valuation too expensive, the question that one needs to ask is, where am I going to position the portfolio? Am I going to move to the demand side growth, which is where the last 4 years shareholder returns have been historically, or am I going to move to the supply side growth, which is where the future growth is looking at from a robust perspective? Finally, we want to be long-term owners of these businesses where the valuation is right. And we continue to expect to outperform Nifty over 3-year cycles. We will be sensible around discipline around valuations, and we will only get fully invested when we believe our portfolio IRR can at least hit a 20% hurdle rate. Till then, we will not shy away from holding cash. What I'm basically saying is we will not run model portfolios.